in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning. We are coming to you live from the CNBC-TV18 Motilal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Morning, guys.
Morning.
Hi, good morning, Prashant. Good morning, Nigel. Interesting turn of events in the last few days, right? After a relentless rally, finally the markets are coming off a bit. So the big question, I guess, is do you continue to buy the dip, something that has worked through to 2023?
I blame you, Sonia, for yesterday. You were not there in the morning, right?
I wish it worked like that, Prashant.
All right.
But I'm here now, so
today we will have some repair.
Yeah.
Okay, well, I'll just quickly tell you what you need to know, right? I mean, it's basically the first time since the rally began in the markets late March. I mean, 31st of March basically is when the market started to go up and has gone up in a vertical fashion. Yesterday was the first time on the Nifty that we closed below the 20-day moving average. First time. You had a bit of a touch points. You had 1 or 2 days of scare in between all these last 3-4 months, but never closed under it. Yesterday we did. On the Bank Nifty, we also closed below its 20-day moving average. The Bank Nifty, I mean, if you just sort of compare the two advances, April, May, June, July, Bank Nifty has been a little more kind of weaker. The advance has been a bit more weaker. So for the banks, we did see 2 or 3 closes below the 20-day, but we are back below it as of yesterday. Now, to the global, before I circle back to levels you need to watch out for, it's steep cuts. So, but, you know, remember, this is the first day that both US and Europe reacted to the rating cut, Fitch rating cut, right? Because the rating cut on Tuesday, I think it was, US markets came after post-close. So yesterday was the first day that markets reacted. Both US and Europe down sharply. The S&P down 1.3, Nasdaq down about 2.25, and you've got the Russell 2000, the small cap index, which was down 1.5%. The 10-year yield is above 4%. It's been above 4% for the last 2 days, but it's not as if it kind of blew the lights out yesterday. It was a 5 basis point advance on the 10-year. The dollar index is above 102, but it was above 102 even before the rating downgrade came through. Now, this is the thing. Data out of the US still is continuing to be extremely strong, right? Now, you get the ADP employment data. This is the private payrolls number. Look at the beat, 324 compared to 190, which was the expectation. So the labor market is still strong. Just 2 days back, we were talking about how inflation numbers are softening. Personal spending is strong, which means the consumer is resilient. You add the labor market data to it and you get a pretty heady cocktail, right? Soft landing or no landing. That's the kind of economy that you're talking about, even at this point in time. The other point is earnings, corporates in US. 80% of companies which are reporting numbers in the US are beating EPS expectations. They're seeing upgrades as well, but they're beating 80%, are beating expectations. Companies in India are not doing that. So that's the other point in time. The point I'm trying to make is that the US, the economy seems to be in a pretty good shape. I mean, there is no problem. You see headlines like a sovereign credit downgrade, etc. You start to wonder, whether things are really going south, etc. Well, they're not. It's basically a reflection of the rating agency's assessment of, how large the debt is ballooning and whether, fiscal brinksmanship, which we've seen between the Republicans and Democrats and things like that. I mean, the rating downgrade has happened. It can act as a trigger for a bit of a pullback, and perhaps that's what we are seeing out there in the US. But make no mistake, otherwise, I mean, the economy, through these data points that I'm presenting, seems to be in good shape. Let's get back to the market here in India. So this is the point. Yesterday's low becomes important. I mean, it's not very far away from where we closed, but we did see a decent bounce. 19,423 was, I think, the low. So 19,420 basically is the level. In the very sort of near term, if the low could be held, I mean, things perhaps could stabilize. It's an off chance, but that's the first number that I'd want to watch out for. The reason I'm saying yesterday's low is important also because, of course, it's a big candle, etc. But if you draw a trend line from the lows of March 2023, we got a perfect touch point yesterday at that 19,420 level, and then the market bounced. So that's point number one. If the low does not hold, and there's a chance it might not, the next support comes in between 19,200 and 19,300. There are a couple of moving averages, and there is an important retracement level as well in that zone between 19,200 and 19,300. Again, I mean, these levels are not very far away. You get 1 or 2 days like yesterday, and we are right there. So that's the other kind of zone into which the market could enter. On the upside, the 20-day moving average at 19,622 becomes a sort of a resistance. Not a resistance, but a level to take out for optimism to come back once again. I don't think optimism is completely out or anything, by the way, just to be sure. But that on the upside is a level to watch. For the Bank Nifty, I just put out one level. The July low of 44,547 becomes the level to watch. We left off almost at about 45,000, so just about 500 points away, 1.5% or so. That's the important near-term support. Let's get to that, and then we'll put out more levels that one needs to watch out for. I said this yesterday, let this play out a little bit. I mean, the broader trend, I would still say, I mean, it's not damaged. If this is a pullback, then this is a pullback within that trend. And I put out a piece yesterday as well, which kind of explained the kind of market we've had for the bulk of the year, which is up. And when an up market meets bad news, more often than not, it kind of looks right through it. It could act as a bit of a trigger, and it could fester for a few days. But beyond that, I mean, I would, I would hold back to saying that, well, this marks the end of this up move and things like that. So let's watch this space. The GIFT Nifty is implying a 60-odd point downtick. Sonia.
Absolutely. And, I mean, the sense you get when you see the screen is that this could be the first real buying opportunity for investors who perhaps missed out, right? I mean, in hindsight, when you look at it, risk aversion globally has always been used as a great buying opportunity for investors. And this time it may be no different. So, there's a risk-off sentiment globally that may sour the sentiment today as well. Remember, both foreign and domestic investors sold in the cash markets yesterday. FIs have now been selling for 5 straight days, so it's been, quite relentless. Yesterday as well, almost 1,900 crores moved out of the Indian markets, and the Dow was down post the Fitch downgrade. There have been earnings disappointments as well in the US, so let's not forget that. Qualcomm was down about 7% after missing both revenue and earnings estimates. And in that context, a couple of key things to watch out for. Apple and Amazon will be posting their earnings later today, so I'm watching out for that closely. And the July payroll report that comes out tomorrow, that will be also very closely tracked to gauge what the Fed's move would be next. But the big question that we're asking is, do you buy the dips? And it has been the most prudent strategy all of 2023 to buy every dip. There's been no real major dip that has come about in the market so far. So if this is the big dip, then should you buy it? Perhaps so. If you look at it, the MSCI Emerging Market Index, right, is up 24% since the trough that we saw in October. And this morning, we have some news that the bulls would latch on to, which is Morgan Stanley upgrading India to an overweight. We'll talk more about that. But the key point they make is that there is a secular trend towards sustained superior EPS growth compared to peers. And that is their base case. They also talk about how India has a young demographic and that will support equity valuations and the upside. So let's see. Let's see if retail investors sort of jump in and use this as an opportunity to buy. But the risk-off sentiment is something that perhaps can continue.
Well, that's right. I think, Sonia, we need to see some kind of stability in the global markets because that's the problem pocket, right? You can't have the Dow down more than 1% and we expect ourselves to outperform. So we could relatively outperform, but you'll want stability, some kind of consolidation in the US markets and then, in fact, take it from there. The FIQs, well, they've turned around, actually, in comparison to what we saw, say, a couple of weeks ago. In the cash market, they sold for the 5th straight day. Now, that's the first time in the last 3 months that we have seen them selling for 5 days on a trot. And yesterday's number was rather large. In the F&O action, well, they turned net short on the index futures as well. So let's take that point a little bit ahead. On the index futures, there was no fresh shorting, but there was unwinding of long positions. Close to 9,000 contracts were unwound on the long side, which takes the long-short ratio now to 49% to 51% in favor of the shorts. And this is the first time that FIs are net short all the way since 12th of June 2023. So it's been a while, close to around 2 months ago, the last time that they were net short on the index. On the index option side, well, they wrote more calls than puts. More than 1 lakh call contracts were written in yesterday's session, which brings us to 2 main strikes. On the call side, the highest amount of open interest addition yesterday was at around that 19,600 odd mark. More than a crore shares getting added out there. On the downside, 19,450 put. Now, the PCR, yesterday as well, we were making this point on closing bell. The PCR went down to around 0.62. And from there, we saw a bit of a bounce. So the lower end of that band is around 0.6. Currently, we're at around 0.75 odd. So, when you see that PCR move closer to around 0.6 odd, then risk reward could favor that buy a trade. Support zone, yesterday's low, 19,424. And a crucial technical level on the downside is 19,380. You want that band to get defended on a closing basis. On the upside, well, you'll say that we're up and going once we get past the 20 DMA. So that becomes a bit of resistance, which was a support on the downside. Even on the Nifty Bank, that was a problem pocket yesterday because that's the one that's been leading this rally. Yesterday, in fact, we went to around 44,721. The 50 DMA as well is very, very close. So you want the Nifty Bank as well to hold on to that band. The GIFT Nifty is suggesting a bit of a pullback of close to around 60 points. Yesterday's low is important, 19,424. Keep an eye out on that mark. And on a closing basis, you want that 19,380 odd mark to hold out.
Okay, well, let's see. Let's hope the bulls can sort of crawl their way back despite all the global challenges. But the Indian market has been one of the strongest. In fact, so far this year, $15.5 billion has been pumped in by foreign portfolio investors, more than any market across Asia, ex of China. But on the equities front this morning, we have an upgrade that's coming in. Jonathan Garner of Morgan Stanley says that their call last October for the beginning of a new bull market in Asia, emerging market equities, is increasingly priced, with MSCI emerging markets up 24% since late October trough, 5% below their June 2024 target of 1100. He says they upgrade India to an overweight for secular leadership. He sees a secular trend towards sustained superior US dollar EPS growth versus emerging markets over the cycle, with a young demographic profile supporting equity inflows.
Well, that's interesting, and we'll talk more about that in a bit. Well, let's get you some money market views as well. Parul Mittal Sinha, Standard Chartered Bank, says that the dollar rupee saw a sharp upside on dollar strength and rise in oil prices. She expects the dollar rupee to trade in a range of between 82.4 to 82.9 to a dollar next week, with the upside capped by US dollar selling by PSU banks amid outflows. She says dollar, oil prices and central bank intervention to stay key forex drivers.
And on the bond, she says domestic rates saw upward pressure on worries of a sustained rise in food prices and rupee weakness. She says higher oil prices and a rise in the US rates aided the up move, with the market unwilling to price in sooner or deeper rate cuts. Next week, she expects the 10-year benchmark bond yield to trade in a range of 7.1 to 7.25%, with India MPC in focus. She says her research team expects no change in rates or stance and a cautious guidance on upside food CPI risks despite low core.
Well, we have a lot of stock-specific action to track for you. We'll get to that in just a bit from now in our special Top 10 segment, where we're looking at Indigo Aviation, L&T Finance, HPCL, Mankind Pharma, Narayan Hrudayalaya, and M&M Financial. They're all the stocks on the back of positive news flow. On the flip side, you have Titan, Gujarat Gas, Vedanta, and Metropolis that will be reacting to negative news flow.
Okay, well, that's the sort of lineup of stocks. Cameron Brand is Director of Research at EPFR Global. He's joining us right now. Cameron, great to have you with us here in the program. Thanks very much. My colleague Sonia was reading out that upgrade from Morgan Stanley. India is the top overweight market for them across emerging markets. With that on one side, assess for us how flows are panning out, and we're starting to get some FII sell flows lately over the last 4 or 5 days. We're not used to it. How long do you think this continues, and what are you seeing out there?
I'm going to hold up my hand and say not guilty, because from the mutual fund perspective, you're still one of the few stars in the firmament. I'm expecting another strong week of flows into dedicated India equity funds. And this despite the fact that the sort of broader environment, especially here in the US, has definitely cooled off a bit from the previous fairly rosy progress that we've seen over the past couple of months.
Cameron, hi, good morning. The flows have been strong. They've been ferocious, rather, right? Since the start of the year, India has got almost $15.5 billion of money from the foreign portfolio investors. Do you think this pace of money coming in is something that can continue through the course of the year?
I think it can. I think a lot depends on whether China delivers on the expectations of much more aggressive stimulus as the year proceeds. There's still a fair amount of money going into China equity funds in the assumption that the Chinese leadership really will step up their efforts to sort of bolster the growth rate. The Chinese leadership has been making the right noises, but being fairly cautious about deploying stimulus. And I think if they continue to be cautious, we'll see more of a pivot of money that's currently going towards China to India. But at the moment, the Indian market is is well valued, has seen a lot of money, whereas I think people are still seeing some potential opportunity in China, given the relative underperformance of the Chinese equity market and the possibility of more aggressive stimulus.
Hi, Cameron. Are we seeing a higher amount of India-dedicated flows? From the emerging basket, obviously we'll get our share, but India-dedicated flows, have you seen an uptick out there?
Yes, it took a while to develop. The flows into the dedicated India funds didn't pick up until your market indexes were already sort of surging nicely. But certainly over the past 10 weeks or so, we've routinely seen above average weekly inflows, often challenging the sort of historic weekly inflow record. And as I said to open my remarks, this week looks like another very strong one.
All right, Cameron, we leave it at that. Thanks a lot for joining in and giving us your view. That's EPFR Global saying that the pace of money that has come into the Indian markets is something that can continue through the course of the next many months. So lots of positives, but not looking good just for this morning since global markets are under pressure. Let's take a quick break. Many stocks to talk about on the other side of the break, so don't go anywhere. Well, thanks for staying with us on Bazaar Morning Call. So many data points to look at today. So our entire research team is joining in now to give us a list of top 10 stocks for the day. Titan will be top of mind post its numbers. Mangalam is here to give us the latest on that. Mangalam.
Well, it's an operational miss which has come in from Titan, telling you that there are some challenges that the company is facing with regards to competitive intensity and a couple of other factors as well. The revenue beat was led by the company selling a lot more gold ingots than what the street was anticipating. So sale of gold ingots was close to around 937 crores. This compares with 356 crores same time last year itself. The jewelry margins of the company were the lowest that we've seen all the way since the fourth quarter of FY21 itself. For all the other numbers, 11,145 crores is the top line that the company posted. The street was, again, working with a number of 10,300 odd crores. The EBITDA came in at 1,100 crores. The street was working with a number of 1,300 crores. And as a result of which, the bottom line was a bit of a miss as well. The reason why the jewelry margins missed, the company said that in the same time last quarter, we had a one-off diamond inventory gain. And secondly, they had ramped up aggressive marketing and brand building initiatives. In fact, even the gold exchange program was dialed up to solve for consumer uncertainty. There was no change in studded share, just around 26 odd percent. And the wedding segment now contributes around 20% to their sales. Let's see where that goes. Even after correcting about 7 to 8% from its recent highs, the stock is trading at 65, 66 times one-year forward earnings, so not particularly cheap.
Well, in fact, we also have the management of Titan joining us at 9:40 a.m. to talk about the past quarter's numbers. Well, Sonia, coming across to you though, Indigo, beautiful set of numbers.
Oh,
fantastic,
absolutely.
flying high.
Absolutely, and I'm going with green over there. It was a record high revenues and profitability for the company. You know, a lot of things worked in Indigo's favor this time around, whether it was the strong domestic traffic, lower fuel, favorable yields, all of that aided margins. Margins came in at a record high of 31.2%. If you look at it also, you know, a couple of other internals, right? I mean, these are the key numbers for you, much higher than what they've done same time last year. And a big net profit. But look at the key internals. Capacity has gone up by 19%. Passenger growth has been over 30% year on year. Fuel prices have decreased by 22.5% on an average. And load factors have gone up 9%. So very good earnings. But let's take a quick look at what brokerages are saying as well. Macquarie, Jefferies, Elara and UBS. Most have either a buy or an outperform, and target prices are ranging anywhere between 2070 all the way to even 3500. That is Elara Capital, very bullish over there. So I'm going with green. But let's not forget that the stock has already rallied 40% from the lows in March.
Oh, absolutely. I mean, you know, the only sort of, in a way, viable aviation play, and that's done very well. Thanks, Sonia, for that. Well, blocks now, Vedanta and L&T Finance will be in focus. Nimesh has got details. Nimesh.
Hi, Prashant. I'll start with Vedanta first, go with red as well. The promoter entity is looking to sell 16 crore shares, which is 4.5% of the company's equity via block deal today. The indicative price suggests a 5% discount to yesterday's closing price, though there is a 180-day lockup now for the promoters to sell further. But do remember, you know, the market had a hint of it. The future was sitting at a discount as well yesterday. So might open in the red to start with, but may see a bit of a short covering as well. But promoter entity selling close to 4.5% equity in Vedanta today. So that's the first one. The second is L&T Holding Finance. Even in L&T Holding Finance, Bain Capital is looking to sell close to 3% of company's equity. The floor price indicates just a 1.5% discount, which looks like the deal will get executed in the block window today. So I'll go with the green there. Though it's not a clean out trade, there is a 90-day lockup. But after today's block, Bain will be left with just 0.5% of the company's equity. So again, Bain is selling a large chunk, but it should happen in the block window.
All right, thanks a lot, Nimesh, for that. Well, let's go across to Sonal. She's tracking Gujarat Gas and HPCL. Sonal, what's the latest there?
Well, for Gujarat Gas, it was a weak set, a top-down miss versus the poll, and there was an expectation of a margin improvement, but that hasn't come by. Revenues were down 4%, EBITDA down 31%, margins have contracted 300 basis points, leading to a net profit decline of 42%. The volumes are lower than estimates, and so is the EBITDA per unit, which is coming at 4.6 versus 5 rupees. The company has also made a surprising acquisition. They have approved equity investment of up to 100 crores in GSPC LNG Limited, which is operating the 5 million tons per annum Mundra LNG regas terminal. This is a related party transaction. For HPCL, it was a beat on all parameters, led by their marketing segment. Revenue was up 4%, EBITDA up 101%, profits were higher, they almost doubled. GRMs, however, were lower than the estimates, so refining was a miss, but marketing was a beat. Jefferies has a target price of 225 rupees a share, but they say best is behind with crude prices inching up, and valuations are also at a historic high, so they maintain their underperform. Nomura has downgraded the stock to a neutral as well, with a target price of 270 rupees a share.
All right, thanks a lot for that. So now, well, let's hop across to Ekta. She's here to tell us about some pharma earnings. Morning, Ekta.
Morning. I'll start with Mankind. Very good set of numbers. Revenue up 18%. Margins have expanded to 25%. Estimates were 21%. Profit of close to 490 odd crores. Domestic business was really led from the front in terms of the pharmaceutical space. So it was up 14% year on year. Consumer healthcare was up 8% year on year. Exports did very well for the company this quarter. 214% growth on a year on year basis. Narayana, highest ever quarterly revenue by that particular hospital company. Revenue up 19%, margins 22% versus 19%, profit up 66% year on year. India growth was 14% and Cayman Islands was up 45% on a year on year basis. Metropolis, that's the only stock which I expect probably some amount of red just based on what they reported. They do have a call at 9 a.m. which might change the trajectory of the stock, but the revenue was down 1%, margins 22.7%, which was a multi-quarter low, profit of around 29 crores, which was down 13.4% and lower than estimates. The margins, in fact, came in at 22.7 versus 24.9% Q on Q as well. The Q1 update had indicated pressure due to COVID-19 base as well as losing a government contract. But nonetheless, I think the street is disappointed compared to the Q1 update as well. Non-COVID revenue was up 4% year on year, what will probably offset the weakness is the premium tests, the wellness, which is up 27% on a year on year basis. Commentary from the management will be important. That's at 9 a.m.
Okay, Metropolis margins at multi-quarter low. No wonder the stock is down almost 10% in the last 1 month and has done nothing in the last 1 year despite such a big market rally. Thanks a lot for that, Ekta. Well, let's go across to Abhishek. M&M Finance came out with a business update. Abhishek, how did it look?
For July 2023, the business update shows that overall disbursements were at 4,400 crore, which is up 12.5% YOY and about 3.5% month on month. So it's the highest monthly disbursements that they have had in last 4 months. And YTD, that is year to date, so far the disbursements are at 16,550 crore, which is up 23% on a YOY basis. Now, collection efficiency has improved to 96% versus 95% YOY and about 96% sequentially, that is in the previous month. But take a look at the collection efficiency number for the month of June 2022. As per the press release that they have given now, it's at 95%. But back in August 2022, when they had given the press release, the collection efficiency for July 2022 was at 97%. So there is a mismatch of about 2% over there. Business assets are up 1.7% month on month. Stage 2 and Stage 3 loans, which are overdue between 60-day and 90-day and above 90-day, they remain range bound compared to June of 2023 numbers. Back to you.
Okay, Abhishek, thanks a lot for that. By the way, those are Cognizant's numbers, and I think the street will take it positively because the FY23 revenue guidance has been maintained. FY24, I guess, revenue guidance has been maintained at $19.2 to $19.6 billion. And if you look at it, even this quarter's numbers, Q2 numbers, revenues have gone up 2% at almost $5 billion this time, quarter on quarter. And the revenue at $4.9 billion, to be precise, is at the upper range of their own guidance. So they have not only maintained their guidance for the full year, but this quarter's numbers also, the revenues have come in at the upper end of their own guidance. So the street would like that. It's a positive read-through perhaps for other IT companies. But we'll get more details on that in a bit. In the meantime, here's a quick recap. Stocks with positive news flow. There's Interglobe Aviation, L&T Finance, HPCL, Mankind Pharma, Narayana Health and M&M Financial. While stocks with negative news flow, there's Titan, Gujarat Gas, Vedanta and Metropolis Healthcare.
Okay, we'll take a very quick break here. Up next, Deepan Mehta, Elixir Equities, will join in for some fundamental stock talk. We'll also have Manish Bhatnagar, Managing Director at SKF India, to discuss the company's performance for the quarter gone by. Stay tuned.
Welcome back. Hope you're having a good morning so far. Let's get our first guest on board. Dipan Mehta, Director at Elixir Equities, is joining us now to discuss a whole host of stocks that have come out with their numbers. Dipan, hi, good morning. One of the stocks that everyone's looking at is Indigo, right? Great numbers and the potential is also very good, but the stock has rallied, 40% since March. You think all the steam is out or is there more to go?
Good morning, Sonia, and thank you for having me on your show. I think it's the beginning of great times at Indigo. First, the disclosure we and our clients are invested. And the reason for that is that the structure of the aviation industry has been far better than ever we have seen in the past. It's a clear duopoly to 2.5 players or so, and pricing power certainly has come back to the industry. And Indigo, I think, has been very aggressive in the past in placing orders, because of which I think they will have sizable capacity also coming onto stream. Keep in mind that several new airports are also being opened that does create new routes for Indigo, and they haven't even explored the full potential of the international flight that also is doing quite well. So I think so long as oil prices don't go berserk like $110, $130 or so, which make it difficult for the industry to pass on, I think by and large these numbers will become like the foundation or the base. And on top of these numbers, you can expect easily double-digit type of top line, bottom line growth. There could, of course, be volatility within quarters, but I think the company should do exceedingly well. And within the air travel space, you have no other choice except Indigo.
Okay, no, absolutely. Take your point, Deepan. Good morning. Sula sold off some almost 10% actually yesterday. Sula Vineyards. Any thoughts on this one?
Yeah, good morning, Prashant. I think some adverse action has been taken against the company because of which this sell-off is taking place. But that's the thing with liquor alcohol companies, that they do tend to get into a tangle with the regulatory issues from time to time. There are so many controls on distribution, on pricing, on production, because of which I think it's not able to achieve the full potential of this particular industry. Sula Wines, I think recent listing, we are observing how the trading pattern is, the company disclosure, and how the quarterly numbers shape up. I think the company has great potential given the kind of market available for wines and the way that entire growth is coming through. So I'm positive on the long to medium term of the company, but somehow I feel that when I look at the quarterly numbers, they are slightly below expectation, but it's on our watch list. And as I said, it's a company which has got great potential. And if there's a deeper correction, then I think the risk-return profile may merit a buy.
And I believe that's there's a big potential for wine drinkers as well. So they are catering to a big market out there. Let's see how that goes. Dipan, morning. What about Titan? One of the big wealth creators. However, for the past quarter at least, the margins were a little bit lower and the quarter was soft on the whole. Your view on the stock?
Yeah, good morning, Nigel. Just kind of go through the fine print with Titan. I think top line numbers were fine, but it's the margins which are compressed. So obviously there is some, I would say, average realization price or the kind of, breakup of revenues, especially jewelry revenues, may have impacted the profit margins, but need to dig a bit deeper. Such kind of disappointments, I think certainly the street will not take it very well, considering the premium, I would say super premium valuations of Titan. So, 1 or 2 quarters miss here and there is fine, but we need to see if this is the beginning of a longer term trend or this is just a transient issue.
All right, Dipan, I request you to just stay with us. For the time being, let's invite our first corporate on the show this morning. It was a good performance coming from SKF India in the Q1. Price realization aided the revenue, while better mix and low cost have aided the profitability. Mr. Manish Bhatnagar, the MD at the company, joins us on the show. Hi, Mr. Bhatnagar. Good morning. Thanks so much for joining in. Well, the first quarter was fairly good, actually. For the year, what kind of revenue growth are you penciling in? And how much of contribution do you see coming in from railways? There's a lot of buzz on that segment. So how do you see that contribution scaling up as well as exports?
Well, we do expect revenues to be double-digit growth for the year, in line with what we've done in the previous few quarters. Specifically on railways and exports, and I do point this out at every call and every interview, that they are not the 2 largest segments for us. So exports is about 7%, railways is about 7%. So I do understand the buzz around those 2 segments, but they're not really needle movers for us.
Sure. I guess, there's a lot of focus on the railways from the government's end as well. Things are picking up fast. So I guess that's where all the interest stems from. But Mr. Bhatnagar, the other thing that the market would definitely like is the fact that your margin profile has improved substantially over the last 5 years, right? I mean, 5 years ago, I think you were functioning at about 12-13% margins, and by the end of Q1, you're almost at 18%. Do you have any more levers to expand margins further? If yes, what are they? And where do you see your margins by the end of FY24?
Yeah, so, we've been working on our strategic imperatives for the last few years, and we unveiled a brand new strategy last year, really doubling down on what we think are the high growth areas for the future. So, for example, clean tech is a big growth initiative for us, and clean tech is electrification, clean tech is renewables, and by the way, railways does form part of clean tech. So that's one doubling down of growth bets. The other one is around the future growth segments linked to our economy. So infrastructure, cement, steel, high-speed machinery. That's the second lever. Specifically on profitability, I think we're taking a very, very hard look at our pricing. You mentioned that in your opening comments, but also on the way we manage our portfolios. We really want to be focused on profitable accounts, profitable products, and profitable ways of going to market. So there is always an upside on margins, and we hope to constantly deliver on those.
No, when you say an upside on margins, what are you looking at? I mean, is it enough? Are these levers enough for you to get to, say, 20% plus? Will you be in the 17-18% range for this year? Just to give our viewers a sense of which way things are headed.
Sure. I think we are certainly aiming for very high double digits, so upwards from where we are right now.
Okay, well, that's knocking at the 20% level then, somewhere there. Manish, hi, good morning. Prashant here. So you've told us about the new areas of focus, etc. But the older segments, the aftermarket business, both in automotives and industrials, I think combined is about 40% of the business right now. How is that doing? Could you give us a sense, and what's the potential there?
The aftermarket on industrial is really running on all, firing on all cylinders. No issues there. The aftermarket on automotive becomes a little more challenging because the aftermarket in automotive is more retail, is more mechanics, it's more price-led. It's not so much performance-led. So there, the levers for growth or profitability are frankly localization and pricing. And what we are focusing on now is reach. The more we can reach, the better we have sales. But on industrial, the levers are completely different. There it's performance, because these are companies, OEMs, buying bearings to replace the current bearings in their machines when they break down. So there the focus is, of course, on performance and innovation, and not so much on pricing or reach. So the different strategies for different segments.
Manish, got that. So industrials is firing, auto may be a bit more challenging. You spoke about buzz, right, and sector buzz. The other sector buzz is that industrial capex is picking up in a large way. Not chunky, large projects, but it's more widespread, etc. Are you seeing that? I mean, you will see that before anyone else. And can you give us how long is that this runway? If this has started, go on.
Yeah, we see this more than any other industry because bearings are used in almost everywhere. The last capex cycle, as you know, ended in 2008. It's been 15 years waiting for those green shoots. But the last 6 to 12 months, those green shoots began as announcements, and now we are seeing actual capex picking up. And as you know, a big trigger for capex is capacity utilizations. Capacity utilizations in many of the sectors, steel, cement, automotive, some segments, energy, are nearing 75% plus. And those are near their all-time highs. So clearly we are seeing capex pick up, and very, very hopeful of the future on that.
Well, that's very good news then, capex picking up. And we take that point on board as well about railways. Since there's a lot of buzz out there, so we normally tend to ask about that, but we get that point. 7 to 8% is what it's contributed, and it will contribute to that. My other question to you is, are you all planning to localize the parents' portfolio in a big way? And I asked you this after the cost of production, it spiraled up in in Europe and also de-risking away from the supply chain. That's away from Russia. So is that a focus area?
Yes, thank you. That's a great question. Absolutely. Localization is a huge focus area for us. And I do want to point out it's localization not just about making bearings locally, the comment you made about localizing parents' portfolio, but also about localizing supply chains. Unless we localize steel sourcing in India, there's no point. We really can't do much with manufacturing bearings in India. So we are focused on everything, localizing supply chains, so steel, rings, and also localizing manufacturing. Today on automotive, we are about 95% local. On industrial, we are about 40% local. And of course, the aim for industrial is where there is room for growth to get to about 60, 70%. So most of our investments are now focused on industrial localization.
Okay, that's great to hear. Just one final question. I remember imports used to be a bit of an issue, the threat from imports, especially low-value imports in the aftermarket. Is that still a concern for you, and how are you addressing that? And also, if you could talk about whether there is a lot of competition coming in from spaces like China.
3 years ago, absolutely yes. Pre-COVID, there was a lot of competition from China. We were concerned about imports from China, Eastern Europe. But I think in general, supply chain disruptions have caused those imports to slow down. I would not say they've reduced or gone away. They've slowed down a little bit. We still face some imports in the aftermarket, some segments, but by and large, it's not something that keeps me up at night anymore.
All right. All the best. Thanks a lot for joining in, Mr. Bhatnagar. Appreciate your thoughts here. That's SKF India. Let's take it straight to Dipan Mehta, who's been sitting by. Dipan, this is a stock that has done quite well, and the management is quite confident as well. What do you do at this price?
Yeah, so very confident answers and really quite encouraging, especially the last comment he made about the export opportunity and sourcing by the parent company. That could be a huge opportunity. I remember that in Cummins, this thing played out really well, and large portion of Cummins revenues comes from the kind of diesel gensets sourced by the parent company. And if something similar plays out in SKF, that could open up a new opportunity for it. Look, it's always been an expensive stock from a price to earnings multiple. But even at these levels, considering that next 3-4 years appear to be a second kind of a compounded secular growth rate for the company, it could be quite a outperformer in my opinion. Need to dig a bit deeper into the company. But I think steel prices should remain benign over the next few quarters or so, and that certainly will aid the margins for SKF. And with automobiles and industrials doing as well as they are, this is a good play on the entire sector, on these two large sectors, which I think looks set for decent growth rates over the next few months and quarters.
Dipan, just one more name. Piramal Enterprises has come off sharply over the last couple of days. I mean, from almost 1,100, now we're down to about 950, 3 days flat. Anything you're picking up here?
Not really. I think it's a company which is still in transition phase. They want to go from wholesale lending to retail lending. But when you come to retail lending, there is intense competition, I think, from the banks, from the other housing finance companies. So I think where is the USP when it comes to Piramal Enterprises? When it was doing wholesale lending to the real estate developers, the net interest margins were phenomenal, and we were hopeful that they would be able to collect and keep the balance sheet in good shape. But that did not actually work out. So they acquired Diwan Housing, and they want to aggressively grow the retail portion of their loan book. But that's certainly going to compress margins, and the cost income ratios also will increase. So no doubt the stock is really, really cheap, I think, compared to the kind of potential which the management brings on in terms of the performance. But I would say that just wait and watch and see how this transition from wholesale to retail plays out, and where really is the niche of this company in this highly competitive retail home loan market.
All right, let's thank Dipan on that note. Dipan, thanks a lot. Have a great day. We'll, of course, touch base with you once again in the next couple of days. Let's slip into a quick break. On the other side, we have 15 minutes left for the pre-opening rates to kick in. Anuj will be with us for a quick trade setup. Post that, we'll bring you the top stock picks for the day from our technical and F&O experts.
Okay, welcome back. There's 14 minutes to go for the pre-open session. Anuj is standing by with a quick trade setup. Anuj, morning.
Morning, Prashant. Well, yesterday sort of changed the trend a bit because the bar yesterday was quite negative and it was accompanied by market breadth also deteriorating quite a bit. The Nifty actually broke the 20-day exponential moving average and closed below that. So in that sense, there's a near-term trend change. The market needed an excuse to fall. Fitch provided that. I mean, it could have fallen for any other reason as well, but there was a reason yesterday. Now, it's possible that you now test the 50-day exponential moving average, which is placed at around 19,100, because yesterday's fall was the first in the current swing where the mid-caps and small-caps participated. That was a bit of a warning sign that perhaps it's time now to exit some of the poor quality stocks, which have also been running up in the last swing. Talking about today's trade, because it's weekly options expiry as well, that complicates things a bit. On the Nifty, we're looking at some levels. 19,423 to begin with, that's yesterday's low, and 19,385, which is options based. These are the two support levels that I'm working with. First resistance, of course, comes in at 19,550, which was holding as a support. That's the 20-day exponential moving average. And the bigger resistance is at 19,600, again, based on the options, the kind of call writing that we have seen. My sense is no trade on Nifty till some kind of stability emerges and we protect yesterday's low and try to take out yesterday's high. That's the only time perhaps a trade comes in. On the Bank Nifty, what was interesting was just look at the kind of call writing that you had in Bank Nifty yesterday. Now this is the 45,000 call. Look at that, 76% drop in premium, and look at the open interest jump, almost from 2 lakh shares up to 37 lakh shares. Almost similar pattern in the 45,100 call as well, where the entire open interest got added in yesterday's trade, and 45,200 call as well, where you saw 28 lakh shares being added in open interest. This is all about today's strike. So it tells you the kind of resistance that you have on the Bank Nifty now. The erstwhile support level, 45,100 to 45,200, would now be resistance. At lower level, support comes in at 44,720, which is yesterday's low. And of course, the 50-day exponential moving average, which comes in at 44,550. Now, that's a level which must be defended, because if you break that, then I think there's trouble.
All right. Thanks a lot, Anuj, for that. That's the market setup. By the way, the news that was expected has come through. Ambuja Cements has now announced the acquisition of Sanghi Industries, and that has just hit the exchanges as we speak. Remember, Gautam Adani in the past has spoken about how the group is looking to become the largest and most efficient cement company by 2030, and they had spoken about inorganic growth as well. But this is something I think the street was awaiting.
Well, that's right, Sonia. Just to give our viewers a few points on this note, Sanghi Industries, the erstwhile promoter, couldn't run the business. The finance cost in the last year was much higher than any kind of profit that they made. That's the capacity that we have. 6.1 million tons, and clinker, excess clinker is what they had. Remember, they were unable to run this business. Last year they reported an EBITDA loss. The finance cost was close to around 240 crores odd, and almost all the shares of the promoter entity was pledged. Now, keep in mind, it appears, going by the details that we have as of now, that only part of the promoters existing, close to around 55-56% odd. The total promoter holding is close to around 72% odd. So that was expected, actually, because there were, there are two families part of the promoter group. So one of the families, it appears, is exiting the business. We're waiting for the valuations. 6.1 million tons is the total capacity. They haven't been able to run it at more than 55% capacity utilization levels. So in the last few years, not even 3 million tons of cement have been sold because they were crunched for money as well. So we're waiting Sonia for this number. As of now, we only have this. They will be providing an unsecured intercorporate deposit of around 300 crores. The deal valuation that's been doing the rounds is close to around 6,000 crores odd, which would be at the upper end. So we'll wait for the final number, but it will be a win-win situation, actually, if it's in this vicinity. Because for Ambuja Cements, they're getting, a higher amount of capacity in Gujarat, and they're getting a good 6 million ton unit. For Sanghi Industries, anyway, the promoter entity couldn't run it. So the valuation is what we're waiting for. 6.1 million tons is the total capacity. Ramping up from here on is going to be important as well. And the all-important EV is what we're looking forward to.
I remember, if my memory serves me correctly, a couple of months ago when you were speaking about Ambuja Cements, you did mention how they're looking to sort of double their capacity as well. and they will have to sort of take the inorganic route. At that point in time, a lot of other companies were also on the radar. They were looking, at JK Cement, I think, as well, right?
Rumors were that they were looking at Nuvoco, they were looking at other assets as well. But Sanghi, given the kind of location, it was always going to be a good fit for them. And talking about their expansion plans, the capacity is close to around 68 million tons now. That's ACC and Ambuja put it together. And they have been talking about moving to around 140 million tons, or we should get some of those graphics up. And they've already, drawn up a plan to add capacity of around 22 to 24 million tons. Okay. So that balance, 40, 50 million tons, it appears some part of that will be fulfilled by Sanghi Industries, because Sanghi Industries has excess clinker. With 6.6 million tons of clinker, you can, actually sell cement of close to around 10 million tons. But their capacity is only 6.1 million tons as of now. So if needed, if demand is good enough, there's a good capacity out there to go ahead and, in fact, increase capacity. And I personally visited the Sanghi Industries unit as well. It's got limestone, which is the key raw material when you need to expand capacity. Okay. So it'll be a strategic fit for Ambuja Cements as well.
Okay, we'll try and get some more reactions to this. If Dipan is still with us, then perhaps we can go to him. But just, another angle to this is this whole debt situation, right? Because Sanghi Industries has about, I think, 1,300 crores of debt on their books.
It'll be, Sonia, close to around 15 to 1,600 crores. So it'll be part of the EV. So the EV is 5,000 crores odd. Sanghi Industries, as of now, the market cap is 2,600 crores. Okay. So I'll be looking at, out of this entire EV that they will come out with, how much of it is debt that's being absorbed? Because then from a Sanghi Industry shareholder's perspective, they have seen the share at around 30 rupees a couple of years back. That share is at around 100 rupees. So how much more is there on the table for Sanghi Industries? But the EV is still not known, Sonia. So we'll have to wait. We'll have to wait. I mean, besides that, anything you want to ask me on both these two companies?
Let's find out what shareholders should do. So I think Dipan Mehta is still with us. Dipan, on this particular deal, of course,
we've got it, Sonia. We've got it. The enterprise value is close to around 5,000 crores. So I think we should get that, for our viewers up on the screen. The EVs come at around 5,000 crores. Some reports were indicating close to around 6,000 crores. So as of now, it appears that it's a good deal for Ambuja Cements, very, very good deal. Because at around, if I just plug in that number, at 5,000 crores, the enterprise value that we get, it comes to around $100 per ton. So that's a good deal. Ambuja Cements is trading at around $180 per ton. This deal is being done at around 5,000 crores. It's a good deal for them. And also they have mentioned that the capacity of Ambuja Cements moves to around 73.6 million tons odd. And the goal of around 140 million tons will be achieved. So that's the big breaking news coming in there. Ambuja Cements will be acquiring Sanghi Industries for an enterprise value of around 5,000 crores. It's a win situation for Ambuja Cements. We'll have to see the contours of the deal, how much of this EV is debt, to find out what does it mean for Sanghi Industries. But on expected lines, this deal has finally come through.
Okay, and positive for Ambuja Cement. Just some more details from the release, right? This acquisition will be fully funded through internal accruals, so there will be no raising of debt. Ambuja Cements will fund the acquisition completely through internal accruals. And they also talk about how they want to make the company a lowest cost producer of clinker in the country. So Sanghi Industries will now be made the lowest cost producer of clinker in the country. And with this acquisition, as we said, the capacity will increase to 73.6 MTPA. Gautam Adani, also a comment coming in from him. Just read that. Ambuja is poised to expand its market presence, strengthen its product portfolio and reinforce its position as a leader in the construction materials.
Just one more point, Sonia. As I mentioned, they have limestone. So they've given this release as well. The capacity that they're looking, cement capacity as of now is 6.1 million tons at Sanghi Industries. They are looking at more than doubling this to 15 million tons. That's part of the release as well. So you should get that up for you on the screen. They've got the key raw material, which is limestone. And they've got quite a lot of clinker as well, 6.6 million tons. That could feed close to around 10 million tons odd. So clearly they're taking this asset and they're looking at ramping it up as well. Dipan Mehta is with us, I think. Dipan, we were coming across to you, but I was interrupting because you're getting more details. What does this mean for the cement industry? You've not been enthused, Dipan, with the cement space on the whole. But this deal, prima facie, it looks like a very, very good deal for Ambuja Cements.
First of all, Nigel, you've covered it really well, and there's hardly anything for me to add except that I keep on seeing this expansion. I think every cement company in India is looking to expand capacity by 50 to 100% over the next 3 years. And I'm scratching my head and saying, where's the demand going to come from? I think end of the day, cement volumes are kind of in tandem with the GDP growth rates. We have 1.5 times GDP growth rates or so. So it's not unthinkable that 3 years down the line, there's a glut situation. And the kind of pricing discipline which has been there for past several years, I think that's certainly going to get vitiated with these kind of expansion plans and aggressive management talk. So, while you may have a bump up in Gujarat Ambuja because the deal really is done at a very decent valuation, but I'm not going to get attracted to buying any cement stock at this point of time. And every rally in every cement stock is a kind of exit opportunity from our perspective.
All right, I'm getting some news from the wires as well. On Bloomberg, they have given that the open offer price for Sanghi Industries as well is 114 rupees per share. So that as well, will be good news for Sanghi Industries as well. The stock was at around 100 rupees yesterday. It was at upper circuit. But, it'll be good news because since they're acquiring more than 55% of the promoter entity shares, they had to launch a mandatory open offer. So I'm waiting for the release. But as of now, this is on the wires that there'll be an open offer and the open offer could be priced at around 114 rupees odd. So a win-win situation. Let's just sum this up. It's a good deal for Ambuja Cements because they're getting a big amount of capacity. 6 million tons, which they're going to take to around 15 million tons. For Sanghi Industries, the existing promoter exits and a more capable and a stronger promoter comes in there to take up capacity. And it's a good deal for shareholders as well because there'll be an open offer out there. For the industry, you want to see consolidation, which will be good news as well. So finally, this deal takes place at around 5,000 crores. Good deal for everyone.
Okay, and Dipan, just before we let you go, a quick comment on the stock as well. Okay, we'll do one thing. We'll take a short commercial break and come back. We have the pre-opening race kicking in. We will also talk more about the markets. Mitesh and Sudarshan Sukhani will join in. Stay tuned.
Welcome back. Well, that big deal has just been announced that Ambuja Cements will be acquiring Sanghi Industries for an enterprise value of around 5,000 crores odd, which is a good deal, win-win for both of them. We have Prakash Diwan who joins us on the show. Hi, Prakash. Good morning. Well, we were waiting for this deal. I think most of the managements in the last 6 months that have come on our channel, we've asked them, are you all interested? Some of them indicated yes. But Ambuja Cements is the one that goes ahead and grabs this price per possession. What's your take on it? They're going to up their capacity from 6 million tons. They're going to take this capacity to 15 million tons. Prakash.
Oh, absolutely, Nigel. So I think except for Ambuja, you've got all the managements on the show, and that's why we missed out. But I think it's a very fair acquisition. It kind of aligns with their avowed capacity expansion from the current levels to all the way to about 120, 125 million tons. So this may not organically, inorganically add too much of capacity, but what it tells you and gives you as an advantage to Ambuja is the ability to also explore logistics which are fairly cost effective. One of the biggest reasons people are worried about cement as a sector is the overcapacity build-up that's happening in terms of everybody expanding. But remember, these capacities don't all come together. They are very calibrated, whether it's Ultratech, whether it's the Ambuja ACC train. So I think it's a great deal. It's almost like 20% less than what the whisper number was going around. So from that perspective, it's quite beneficial to Ambuja, and they will be able to get a lot of efficiencies out of this whole thing, because Sanghi has been plagued with a lot of debt, and it's been running into operational losses more because of certain inefficiencies of scale. That will be remedied in this post this acquisition. So quite nice win-win, I'm sure.
Yeah, quite nice is an understatement, right? The Adani group is going big into this space now. I mean, their total capacity will be, 101 million tons per annum by 2025 is what they say in the release, right? After everything that comes through, they have their ongoing capacity of 14 million tons per annum as well. They have a commissioning of 5.5 million tons per annum capacity at Dahej and Ameta by Q2 of this fiscal. So lots coming on stream. And now, of course, the Sanghi Industries acquisition. But Prakash, I wanted your thoughts on the stock, because, if you look at Ambuja Cements, right? I mean, in February, it was at 329. So in a sense, it's been, a 40% move since the month of Feb. Do you see lots more upside for, a retail investor here?
So, it's like this, Sonia. As you rightly said, they are looking at becoming very significant in terms of the industry presence. Now, when they're building up to that, it's the phase of capital expansion, capacity expansion. Those are periods where you don't really see stocks do tremendously well. It is only once that impact has started to feel on the market, on the operating leverage, then you will probably see a re-rating of the stock. Right now, it would probably be range-bound, but it's very, even the numbers which came through, there's nothing disappointing in spite of, all this slowdown and seasonal slowdown and structural changes that are happening in the business, in the group itself. So my sense is at 450, 460, it's probably not going to offer you a very quick reward. But at the same time, it's also priced in all the negatives that could have come. So, which means it'll probably consolidate at here. It's a good bet to play the cement sector, provided you are convinced that the next couple of years are going to be okay in spite of all these capacities coming up.
Right. Well, at 9:50, you'll hear from Karan Adani, and we'll kind of play out sound bites there. Prakash, always good speaking with you. Good perspective. Thanks very much for joining us here. For now, we'll have you back soon again. Well, I just want to quickly highlight, let's just focus back on the market. We are in the pre-open session already. The Nifty and sensex exchanges at the bottom of the screen. Just some data points, right? I mean, the big question in people's mind is this, that will this Fitch downgrade act as finally the trigger? We've not had even a 3, 4, 5% pullback even once since the rally started in some of these indices all the way back in 2020. So will this be that trigger? Actually, I mean, especially the small cap index. Now, I put some data out, and Mitesh and Sudarshan are with us. And gentlemen, if you can hear me, I would just want to kind of come to you on this and get your perspective. This is the data. So, what this basically shows is that when the 2011 downgrade happened, what were markets doing going into that downgrade? That is the second column on your screen. And the last one is what markets have done now, right? Up till the point that the downgrade happened. As you can see, S&P, NASDAQ, and the Nifty were all selling off, anything between 4 and 15%, 13%, even before the 2011 downgrade happened. On the other hand, it's exactly the opposite. Markets have been rallying strongly between 10 and 35%, even before the Fitch downgrade came. That's one. That's the first point. What happened after 2011, 1 month after the downgrade? So the second column is basically the same, which is what these indices did going into the 2011 S&P downgrade. And then the second column is 1 month later, approximately 25 to 30 days later, where markets were. Nifty had sold off 11%, S&P had sold off 7%, Nasdaq had sold off another 8%, right? So markets were down going into the downgrade. They fell more after the downgrade back in 2011. This is the point. Now, of course, we only have question marks there, and that's essentially all the entire debate, whether we will see a repeat of what happened in 2011. The backdrop is different, and that matters. We are in an up year. In 2011, we were in a downtrend in any case. And that's the point I want to come to Mitesh and Sudarshan about, whether, you know, this kind of goes back to trend following. If in a strong up market, and we've been in one, how is bad news treated? You know, does the market, I mean, maybe the issue festers for a bit, that's perfectly fine, but does it change the trend overall? I think that is the question. I would say no, but I want to hear from the experts. Sudarshan and Mitesh are with us. Sudarshan, first to you. I mean, just a quick comment on the data that I put out, and then we'll come to you for your calls. Go on.
Well, I'll answer the later question. How is bad news treated by the bull market? And the bad news is ignored. Sometimes it's ignored in half an hour. Sometimes it takes 5 days to ignore. But in a bull market, bad news, it becomes almost irrelevant.
Mitesh, what about you? Same question?
Prashant, I think a very similar kind of reply. I think, you know, what is happening right now is that we have had a rally. If you look at the Nifty weekly chart, rally from levels below 17,000 to as close as 20,000. Practically, we did a high of 19,991. And we were very overbought with that. There is some bad news. It will lead to profit booking, but does it give any signals of a trend change? I don't think so. So I think if this downgrade does lead to some profit booking, and the chart setup is definitely like that, I think between 19,200 to about 19,000, give and take 20, 30 points, 50 points, I think, you know, you will see the index kind of bottom out, and that will be a wonderful entry point. I think this overall market scenario on the weekly and the monthly charts remains bullish. Therefore, I'll trust that this trend will continue because I don't have any signals of a reversal.
Okay, I do want to get a couple of stock ideas out of the way, but before that, let's just take a quick look at what's happening in the market. Titan is your biggest loser on the back of an operational miss that the company has seen this time. So Titan is down 1.5%. You have Metropolis, where the margins are at a multi-quarter low, so that stock as well is under pressure. Indigo reported record high numbers, so that one is in the green at the moment. Metropolis down about 2% after very weak numbers. Indigo up about 0.3%. And then Narayana Health reported its highest ever quarterly numbers, so that stock as well is in the green right now. Plenty of stocks to talk about. So Darshan, what would your stock ideas be for the day?
Yeah, but before the stock ideas, I'll quickly tell you my view on the Nifty. Yesterday, I was suggesting going short in the Bank Nifty. That luckily worked out. On Monday, we went long in the morning. That worked out. Now, 2 trend days in a week are more than enough. For me today, the Nifty is a complete avoid. I have not the faintest idea what markets will do for the day. Asian Paints is a buying opportunity. The stock had a decline, but after that, it's been consolidating, including yesterday when it did not fall. Buy with a stop under 3,300. I have a short sell, intraday short sell in Canfin Homes, which is suggesting the breakdown of a support level. It's an intraday short with a stop above 743. Then I have a buy in Divi's Lab. Pharma stocks, always they do their own thing, and sometimes they simply ignore the market action. Divi's Lab is a buying opportunity with a stop under 35.75. And UPL, which has been in a bear market of its own, continues to fall and is an intraday short with a stop above 630.
Okay, and Mitesh, what about you?
I have a mix of buy and sell calls, 2 buys and 2 sells. On the selling side is ABB with a stop at 44.56 for targets of 4,300, and Bajaj Auto. Conditional sell if it breaks 4,800. Short with a stop of 50 points, 48.51, and a target of 4700 can be looked at. And on the buying side is Voltas with a stop at 790. Buy for targets of 830, and Marico is a buy with a stop at 554 for targets of 5.
Okay, there's a block deal that has happened in Zomato. So almost about 39 lakh shares have exchanged hands on Zomato, and that stock in pre-opening is actually down almost 4%. So just keep an eye out on Zomato. Let's go across to Nimesh also to find out what the standout brokerage report of the day is. Nimesh, over to you.
Hi, sorry, sir. Today's standout is on M&M Financials. A rare downgrade coming in today. So JP Morgan has today downgraded the stock to underweight from neutral, and they have a target price of 250. Now, JP Morgan believes that while the growth is coming thick and fast, the consistent operating profit margin degradation puts the ROA point into debate. In fact, in quarter 1 as well, the AUM growth was 28%, but the PPFO growth was just 6%, largely dragged by the lower NIMs. Now, for FY24, JP Morgan has cut the EPS estimates by 14%, and for FY25, they cut the EPS by 4% post the weak quarter 1. So, a rare downgrade on M&M Financial. Today, JP Morgan has put an underweight with a target price of 250.
Okay, thanks a lot for that. But let's move to the upgrades now. Morgan Stanley has upgraded India. Vivek has more details on that. Vivek, over to you.
Well, good morning. A very interesting note coming from Morgan Stanley today morning. What they've done is they've gone ahead and raised the India rating that they have to an overweight stance, and at the same time, they've gone ahead and downgraded their rating on China to an equal weight stance. What is their call on India? What is it that they like about India? Number one, they believe that it is now the start of a new era of outperformance versus China as far as India is concerned. They also say that relative valuations are less extreme than it was when compared to the month of October 2022. Along with that, they're saying that a lot of macro factors, young demographic profile, supports equity inflows. Also, they're talking about real estate. They believe real estate transaction volumes as well as construction have broken out as far as the upside is concerned. Now, they've also gone ahead and compared China versus India on a few key parameters. Now, manufacturing and services PMI that they're talking, they believe that post-COVID, India is seeing a rapid expansion, while at the same time, China is seeing a rapid fading away as far as these key parameters is concerned. Along with that, as far as private equity is concerned, private equity is looking to expand their presence in India. At the same time, in China, they're actually struggling with exits. Lastly, as far as the Asia ex-Japan focus list is concerned, they've gone ahead and added Larsen & Toubro as well as Maruti, and at the same time have excluded Titan from that particular list.
All right, thanks a lot for that. Well, Interglobe Aviation is the other one that we're looking at. The stock is up almost about 0.5%. Record EBITDA and revenues in Q1 on the back of very strong domestic traffic. Almost a 30% passenger growth is what you saw. Lower fuel costs. Fuel costs were down by 20%, and favorable yields aided earnings. Also, the grounding of Go First created a vacuum in terms of supply, and then, Indigo jumped in and gained market share. In fact, Indigo now has over 70% market share in some monopolistic routes and 60% market share overall in the industry. So that's the, might with which it flies at the moment. Remember, the stock has also rallied almost 40% since the month of March, so keep that on your radar. And there are a couple of risks in Q2, which include higher fuel prices. Fuel prices have moved up, as well as lower yields. We'll be speaking with Peter Elbers, who's the CEO of Indigo. He will be with us at 9:30 a.m. later today, so do stay tuned in for that. But let's head to the market opening now, which comes through in just about a couple of minutes from now. Today could be a slightly weak opening, so the Nifty is down about 62 odd points, dragged lower by Titan, of course, on the back of weak set of numbers. It was an operational miss. In fact, there's a downgrade that has come in on Titan from CLSA as well, where they have downgraded it to an outperform from a buy, and they have a target price which is still higher though at about 32.70. But they say that margins are showing some moderation, so that is a bit of a sticky point. Apart from that, the Bank Nifty has been on the weaker side in the last many days. So ICICI Bank, a couple of others are dragging the market this morning. And then you have IT as well. So TCS, Infosys, Tech Mahindra are all in the red as we speak. But some result reactions could be watched very closely, like Metropolis, where the margins have come in at a multi-quarter low. Okay, there you have it. The first take on the index, which is down about 60 odd points. The Nifty is below that 19,500 mark. And the mid-cap index is absolutely flat. So yes, there's a bit of a downtick in the market, but it's nothing too alarming at the start of trade. The Bank Nifty is now down about 150 points as well. What's dragging? ICICI Bank is your big loser. Titan posts its numbers. Maruti Suzuki, after the margins moderating as well as that SMG acquisition, has been slightly under pressure. Bharti Airtel down about 0.6%. Hero MotoCorp, very weak numbers in the month of July, so that one continues to drag its feet, and UPL is down almost 1.5%. On the upside though, Pharma is holding up. Sun Pharma, Divi's, a couple of others in the auto space, Bajaj Auto, Tata Motors are not too bad. But today is a weak day, weak start actually. 75 points now lower on the Nifty, and plenty of result reactions as well in the broader market, so we'll get to that. But what stands out, I think, is names like Delta Corp, VIP. Interglobe, by the way, is down 3.5% right now. We were mentioning how the stock has run up quite a bit. So, perhaps some profit taking.
Yeah, landing for a bit at least as of now. But from the broader market, Sonia, Gujarat Gas, those numbers look disappointing. Stock down close to around 4.5%. Vedanta, that large trade going to take place. Promoter entity will be selling close to around 4% equity in the company. Remember, we were highlighting this yesterday that the futures were trading at a bit of a discount. So there was a probability that there could be some kind of corporate action. And that seems to have played out. So that's where that stock's down close to around 5%. Godrej Properties as well has lost another 2.5% in today's session. On the flip side, you have a few stocks that are doing well. Oro Pharma holding strong with a 2.2% gain. You have India Bulls Housing Finance as well. That's up close to around 2%. So those are a couple of big gainers from the broader market. Sanghi Industries. Well, the stock opened up close to around 5%, but at higher levels, it seems, because of the kind of run that we have seen, the open offers are around 114 rupees, but there is some supply that's creeping in there, and there's massive volume that we're seeing. Last few days, the stock has been locked in upper circuit. As we speak, there is some supply that's hitting in there. You have a couple of other cement names as well that are buzzing. Star Cement is up close to around 4.5%. So pretty good news out there. And Ambuja Cements, well, the stock is holding mildly the green with a gain of close to around 0.5%. The big deal on Vedanta, that's taken place. Promoter entity likely to be a seller, as Nimish told us earlier. Stock down close to 5%. Prashant.
Well, Nigel, thanks for that. Well, Mankind is the big one, right? I mean, I think as you guys were also pointing out, 7% gain. That's on the back of very strong numbers, by the way. So 1861 on Mankind Pharma, and it's got tremendous volumes as well. The other one from the last 3 or 4 days, which has been doing well, is India Bulls Housing. So it's up another 3% after 7% yesterday, and I think 5 or 6 days before. I mean, India Bulls was up even in a market like yesterday. Star Cement is the other one, which is up 5. We've got KSB Pumps, I think, which is up about 5.5%. So some of these names are newer, but not new. Well, Poonawalla FinCorp is up 2%. KEC had a very strong day yesterday. KEC is following through with about a 2% gain. And Oro Pharma, I think we already highlighted. Campus reported numbers, and it kind of sank yesterday, but that is coming up about 2% or so. Narayana Hrudayalaya is up about 1%. So it's a slower start. I mean, maybe I'm looking at the wrong screen. I'm looking at the stocks which are going up. So let me look at the stocks which are going down. Vedanta, Indigo. Yeah, I mean, there's a lot. Delta is down 6%. Delta Corp. So 185 on Delta Corp on large volumes at this point in time. It'll come up. And we've got Gujarat Gas, I think we highlighted. UPL is down about 2.5%. VIP Industries is down about 6%. We've got Ultratech, which is down 2%. Dabur, HPCL, Godrej Properties, Adani Wilmar, Paradeep Phosphates. I mean, not a new listing. It's been around for a couple of years, but relatively newer. 7% or so lower. I don't know if there are results at play or something, but that stock is down. Reddington sank yesterday. There was a big margin miss there. Reddington is down 2.25%. So, I mean, it's buzzing on both the way up and on the way down as well. Lots of action in the broader market. The Nifty is doing, I would say, just fine. We're down about 40 points, 45 points. So, on a 19,500 index, that would count as being, I mean, flattish. So we'll see. Market breadth is the more important thing that I would watch. And for now, it is holding. 1,100 stocks are higher and about 700 stocks are lower at this point in time. Manish Gunwani is with us, Head of Equities at Bandhan AMC. Manish, good to have you with us here. Good morning. Thanks for your time. I mean, it's been a very strong market and it's been very rewarding. And I think most people, even if, especially, and if they've not done very much, have made money on the portfolios. If you did too much, maybe you missed out. How are things looking right now to you, Manish? We've had a bit of a hiccup, especially over the last couple of days with this Fitch thing. Do you think it'll play out in any significant way, or the market will look through it and carry on?
Well, I don't think it's going to be very significant. I think it's a typical bullish market correction kind of thing. Because logically speaking, I mean, you have the world's reserve currency, which can always print money. I mean, we live in a fiat currency world. And to imagine that US would default on its debt is to me, it's a very, very, very remote possibility. So I don't think this is going to be anything significant. It doesn't change the trajectory of the global economy, the US economy, the earnings outlook of anything. So to my mind, it's one of those passing showers kind of stuff. I think we live in a fairly healthy macro for India, at least. We've all talked about how whether it's inflation, current account deficit, growth, geopolitical stability. Things look good for India. Valuations are not cheap, but I think that as long as the dollar is weak, there'll be liquidity in the world. The competition for liquidity is quite weak because China's obviously going through what seems to be a structural slowdown. A lot of the other emerging markets have bigger problems. So I think that broad positive outlook in that sense remains.
Okay, by the way, in case you're wondering what's happening with Delta Corp and why that sudden slide in the stock, let's get Delta Corp up for you on the screen. This is the latest update on the virtual GST Council meet that was held yesterday, and the Council has decided that there will be no rollback on the 28% GST on online gaming, horse racing and casinos, clarifying on the levy. So the Council has now decided to impose tax at the entry level, and that's what's caused this fall in the stock. However, it does not intend to levy GST on the redeployment of your winning amount. So the 28% GST is expected to come into effect from October. However, with Delhi, Goa and Sikkim dissenting, the Council has agreed for a review as well 6 months after the implementation. So, that's the reason why Delta Corp is down almost about 5% odd. We'll get to that in a bit. We'll get more details on that in a bit. But Manish, how are you feeling about, some of these spaces that have come back in a big way, right? I mean, pharma, case in point. Most of these stocks have reported decent numbers. Pricing pressure has gone down in the US. In fact, this morning, something like Mankind Pharma has reported a 500 basis points margin improvement quarter on quarter. That's the kind of operational push that we're seeing. How are you feeling here?
So in general, we have an overweight on the sector. I think that we've seen a fairly long period of US generic pricing remaining under trouble. Even the domestic pharma growth has been tepid. So from a risk-reward basis, by reversion to mean, obviously the cycle seems to be now reversing. While stocks have done well over the last couple of months, but if you see from a long-term price performance perspective, a lot of these stocks are way below long-term highs. So in that sense, I think this is a cycle which is now slightly gathering momentum. It's obviously not distressed valuation right now, but I think it's early days of the upcycle. So there should be, in case the cycle pans out, which we hope it will, then I think there is decent upside in a lot of these stocks.
Manish, I mean, you guys are building portfolios, right? I mean, you're in a way, the newest kid on the block. I mean, not that new now, but if you're building and you're getting money, so as you build a portfolio, like say for example, a mid-cap fund portfolio, how do you do it? I mean, how are you allocating money now? Just give us a broad sense, sectorally, but from that perspective.
Yeah. So, Prashant, basically, I think there are 3 or 4 themes we've been kind of positive on. The first was that last few quarters, we felt the domestic economy, the domestic cyclicals are better than the global cyclicals. The second was revival in rural consumption, which is two-wheelers, microfinance, some FMCG kind of stuff. The third is the capex side with a specific focus on power, where we feel that both domestic demand supply and the global transition to green energy presents a lot of opportunities. And fourth is healthcare and pharma, right? Now, in this, I think the first two, I think, have got diluted in the sense that the apprehension a lot of us had about the global economy slowing down a lot, that seems not to be playing out, in the sense that the US economy and even Europe probably at the margin have done better than expectations. And in terms of rural economy revival, quite a few stocks have done well, but has not really been that powerful, the bounce back in rural consumption. The energy theme, I think, has been probably the strongest. We do definitely see a lot of turnaround in investments in power. The kind of demand globally for transformers, cables, etc., is very strong. That theme seems to be playing out well. And as we just discussed, the US generic pricing theme on the pharma side also seems to be doing okay. So we're kind of toggling among all these four thematic views. This is not to say that certain stocks in consumer discretionary, etc., you love from a bottom-up perspective. But yeah, I think in terms of playing cycles, these are the four cycles we probably are playing most.
Okay. Manish, how are you feeling about the cement industry now? Heavyweights like the Adani Group making their presence felt with another acquisition coming through of Sanghi. But, you know, this is a space for investors has not given the best returns, to be honest, in the last 4-5 years. Do you think that it's a start of a new upcycle now with so much consolidation also happening in this space?
So one is, as I said, we typically are more in domestic cyclicals versus global cyclicals. So we, obviously cement is one part of the domestic cyclicals. But personally, I think this is not an industry which has very strong growth for the medium to long term. So I'm not very hot in cement per se. But obviously, we are again in an upcycle in terms of demand. Q1 demand has been very, very strong. So yeah, I think where we can find bottom-up value, we will look at it. But is it, very long-term buy and hold kind of sector? I don't think so.
Okay, all right. Manish, we leave it at that. Thanks a lot for joining in and speaking about the market as well as all that's been happening lately. By the way, it's not bad. So we were talking about how that buy on dips is something that could perhaps work out. Just look at the Nifty. It's at the high point of trade. The mid-caps have actually moved into the green and the Bank Nifty is also in the green. So perhaps retail looking at it as a buying opportunity, the kind of sell-off we've seen globally. But Interglobe Aviation has reported very strong numbers in the first quarter, beating street estimates across all parameters. The revenues rose nearly 30%. It's an all-time high on revenues and profitability. Let's listen in to Peter Elbers, the CEO of Indigo, in conversation with Shireen Bhan.
Peter, let's start by talking about the standout quarter that you've been able to deliver on. The question, though, is this sustainable? Are you going to be able to replicate the kind of margins which have come in at a record high of almost 31.2%, record revenue as well as record profit? In terms of demand and in terms of the external environment, will you be able to redo this performance?
Well, indeed, this result for this quarter has been actually a wonderful and very, very strong result. And a lot of things were coming together in this quarter. And if you take a little bit of a step back at COVID, we had pretty much 10 quarters of consecutive losses. And by the end of, actually by the middle of last year, as from the third quarter, we're back into profitable territories. So now for 3 quarters in a row, we're back into black numbers, black figures. And this quarter obviously has been the highest one from the 3. And what we see really is a combination of 2 factors. Firstly, we see a very strong demand in the market. The Indian economy is growing, Indian travel is growing, visitors are growing. So a very strong market demand, and India does not only have one of the fastest recoveries post-COVID in the world, but also a very solid demand going forward. The second factor really, what is helping us, is that we have launched a whole range of initiatives last year, and we see that all these initiatives start to pay off.
We've seen significant amount of capacity being squeezed out of the market. Go First, there is no clarity on when it is likely to relaunch. There is no Jet Airways at this point in time. SpiceJet is facing its own set of troubles, as are you on the supply side. But how much of the capacity constraints are actually aiding you at this point in time, and what could that potentially mean in terms of market share addition?
I think we prefer to look at Indigo at what we can do and how we are able to help the market with the capacity what is needed. And since we had the first challenges in the middle of last year with some of the supply chain challenges forcing us to take some mitigating measures, we've been very, very consistent actually in meeting our capacity guidance. We've given a guidance for last year. We've met the guidance even slightly higher. We've given a guidance for this year, and in the call which we had earlier today, the north mid-teens are just repeated. So what we have actually in place at Indigo is a whole range of mitigating measures, some extension of leases, and we are, of course, in a situation whereby we do have a steady flow of aircraft coming in. To your question on Go First, yes, the suspension of Go First flights in early May created, of course, some certain market disruptions and dynamics. However, I should say after a couple of days, you see that things are stabilizing. And for us, for the 400 plus domestic routes we're flying, there was like 15 to 20% of these routes were also operated by Go First. So the actual overlap on our network was limited, I should say. The majority of the growth, what we're seeing, is really the growth of the market. And if you just compare today's market numbers to that of the situation before COVID, we're actually significantly higher. And for us, year over year, we almost had a 30% growth in terms of passenger numbers. So that's really new market. And we keep seeing, and that's one of the, I would say, one of the strongholds of Indigo, we keep seeing a lot of first-time flyers in our aircraft. And the very strong government policies in promoting air travel and making sure that smaller communities have access to air travel, that's really supporting the growth of aviation in India itself.
But Peter, you talked about Go First, and I would like to address the rumors and reports appearing in the regional press that suggest that Indigo might be interested in Go First. Is there any truth to that at all?
Indigo is focusing, again, I'm not reacting to any rumors, but Indigo is focusing on develop our own company. We have a steady flow. I mean, even before we placed the most recent mammoth order of 500 aircraft, we already had 470-ish aircraft yet to be delivered. So we're in a strong position to build our company and build our brand, and that's really our focus going forward.
Peter, let's talk about some of the challenges that you need to contend with as well. And I know that you addressed this on the investor call, so I'm just trying to get a little more clarity from you on the Pratt & Whitney recall aspect. In the first phase, Pratt & Whitney has announced that starting September, they will recall about 200 aircraft globally. Now, you've said that that will impact Indigo in single-digit numbers. You already have 40 aircraft grounded currently. So starting September to perhaps the end of the year, which is part of the winter schedule that you have to factor in, what will be the operational fleet size? What will be the grounded fleet?
Yeah, well, today, and we said we have the highest in the high 30s of AOGs, and today I think we communicated that we're having around 40-ish aircraft, which of course is driven by the supply chain. In addition, and that number is actually pretty stable over the past time. That most recent announcement of the first batch of 200, I mentioned a single number or single-digit number actually for Indigo, so that for the weeks and the months ahead will not have a very significant impact. Those are the numbers we can deal with within our capacity guidance. And again, today, even for the full year, we have repeated our capacity guidance of the north mid-teens. So we don't know yet precisely what's going to be the next phase of the Pratt inspections to take place. We don't know precisely what's the impact of that. We will work closely with Pratt whenever we have more information, whenever we get more information. We would like to be totally transparent. That's why we shared in our investor call whatever info we have, we share there. I think it's important to be transparent. And of course, we are working like we did last year.
Let's talk about the other challenge. And, it's actually been a better environment as far as crude is concerned, and you've seen the benefits of that play out for you in the quarter gone by. But we've now started to see crude prices inching up, and that's resulted in ATF moving higher as well. How much of a risk factor is that at this point in time? What are you penciling in?
Well, there's obviously some global fluctuations in the prices of fuel, and Indigo, of course, is just affected by these global fluctuations. And one quarter the effects are positive, and another quarter they could be negative. So I would not be in a position to predict or to speculate. And I think I've said that before, I'm not sure to you, but if I were to be able to have a precise prediction for oil prices, I probably would not run an airline, but have a different job. So we just follow actually here. I think in the long run, actually, we see that there's always a correlation between fuel prices and actual prices of tickets. You mentioned ATF. I think what's an important element in India today is that more and more states and more stations actually, as part of the government policies, are lowering the taxation on the ATF and aligning that. that helps a lot in order to make sure that India becomes more and more a global aviation hub. And we're not only looking to passengers within India itself, but even passengers traveling to and from and via India. And more we're building that connectivity and that connectivity system. And that in itself will also help us to mitigate some of these fluctuations in prices which take place anyway.
One of the concerns is that there is a crisis of confidence within the lessor community. How are you reading that? How is that likely to impact agreements going forward? Are we already starting to see that being penciled in as far as security deposits are concerned, change in agreements at this point in time? How do you see this playing out for India in the medium term, given the current environment?
Well, I think we should probably make a bit of a differentiation between what's the trend and the direction and what are our actual situations. And the trend and direction of India is that India will grow as an economy. India will take a even more prominent place on the global stage, and as we basically see that growing by the day. With that, the Indian aviation market will continue to grow, and actually whatever prediction you follow, and being at the IATA conference a little less than 2 months ago in Istanbul, it was all about India, looking at the air show in Paris, where Indigo announced its order and Air India did it slightly before that. It was all about the growth of the Indian market. So the general direction and the general focus on India becoming such an vibrant aviation market, that is there. Then, of course, there's the situation around Go First, which we follow closely, where it's important that it is matching some of the international standards and practices. So I think it's a bit premature to now connect the two and say, because of this, that will happen. Again, what is important is what's the long-term perspective, and how some of the actual situations, which I think it's still under development, it's probably not totally worked out. There's still some work in progress and some discussions going on, to my understanding, without being aware of all the details, which are, of course, taking place behind closed doors. I think the overall direction is clear, and India will continue to be developing as a global aviation powerhouse.
Welcome back, folks. So the market is slightly under pressure, down about 40-odd points, but the stock on our radar is tightened right now. We have Sanjay Purohit, the whole-time director and Group Chief Executive Officer of Sapphire Foods, who will also be joining us later on the show. But we have now Ashok Sonthalia, who's the Chief Financial Officer at Titan, who's with us. Mr. Sonthalia, good morning, and thanks a lot for joining in. There's, of course, an operational miss, which I'll talk about in a bit, and I'm sure there's competitive intensity which you're facing. But I want to understand on the top-line front, right? Since we're getting into a period where there is Adhik Maas, which perhaps could affect, it's an inauspicious period, so it could affect sales. Q3 onwards, there'll be a lower share of weddings as well. Do you think this could be an impediment to your revenue growth? And what are you targeting in terms of revenue growth by the end of the year?
We are, of course, looking for high-teen growth numbers for FY24 as well. I would believe we talked about that July month has been, again, almost as good as Q1. So we have not seen Adhik Maas impact that way. Q2 is always a diamond activation quarter for us. So we had some new collections which we launched towards June end and marketing campaigns around that. And now the diamond activation is getting very, very good response, which is started towards July end. So it's very difficult, Sonia, that way to predict these days. A little bit volatility in the market. consumer sentiment oscillating sometime to lukewarm to coming out in large number for buying jewelry. Our strategy has been respond to some of those good periods where sentiment is good, prices are good, come out with campaigns, design, offers, etc. to maximize at that point of time. I think volatility and all these things are going to stay. We have to kind of manage within that. And we are still hoping that high teen growth for FY24 is possible.
So I just have one follow-up here. Given that there's so much competitive intensity and the market is still a bit challenging, Mr. Santalia, do you reckon that the most prudent strategy would be to focus on volumes and revenues, and some of that could come at the cost of margins? Since you spoke about some of these schemes, discounts, etc., that you'll be offering in order to move forward, what could the most prudent strategy be in a challenging time like this?
So our philosophy, and which we have talked about, that growth is first, market share gain is first, and then deliver at a consistent margin profile. And that is what we are trying to do. We spoke about our long-term growth strategy about jewelry business, which we articulated on FY22 base as 2.5x by FY27. We are very much on track to that. 12 to 13% margin guidance also remains for the full year. There is seasonality from quarter to quarter, and margin will go up and down slightly. Quarter one generally have slightly weaker. Also must remind all of your viewers and who track our stock that FY23 margin profile, we always spoke about that. It has got one-off benefit which are not going to stay. So keeping all the points, our investments in quarter one, our gold exchange program in quarter one, and that is what the margin we planned for quarter one. I do understand that market perhaps had a higher expectation from us.
Yeah. No, so do they need to be guided a little lower? Mr. Santalia, good morning. Prashant here. Because that's the point. Margins are down in the jewelry business, down sharply, 250 basis points. You alluded to some of the reasons, like, for example, FY23 was there were one-offs, they were never going. So is this the normalization we should expect, and what would you guide for the full year, sir, in the jewelry business?
We reiterated 12 to 13% is the band within which we will operate. Within 12-13%, I don't want to guide any further. If you look at, Prashant, several years, say last 3-4 years, quarter one being at 11.5 and still we delivering 12 to 13% has been the trend. So maybe FY23, that one-off situation has created an expectation as well as disappointment. But we, as I told you, we are as per our plan, and we are not getting concerned about that. Competitive intensity is there. It has been there for last 12 to 18 months. And I don't believe there is any more pressure coming because of competition. It is more the consumer sentiment oscillation, the market gold price volatility, that is more concerning for us. And that is what we kind of design our responses to.
All right. Hi, good morning, Mr. Santalia. This is Nigel on this side. I had a two-part question to you. One is that your current market share is around 7%, and you've said in the next few years it goes to double digits. By the end of this year, what kind of market share are you looking at? Point number one. And the studded share, well, it's holding at around the 26% odd. For quarter two, quarter four, where do you see this number headed?
So in quarter two, this should be certainly upward of 30% plus, Joan. I can't tell how much higher, but definitely 30% plus number we are expecting. Same thing can happen in quarter four also. Overall, I think we are reaching or might exceed the pre-pandemic level. We were just behind till last year. This year, we do hope, because of our campaigns around studded jewelry, high value studded jewelry, getting very good traction. So we are hopeful that we can at least come to pre-pandemic level and maybe slightly better off from there. So that's.
And what about market share, sir? Market share from around 7%. You want to go to double digits. By the end of this year, are you outgrowing the market? So will you gain on that market share? Will you go up by 100, 150 basis points for this year itself? And also just to revise, what was the pre-pandemic level of the studded business contribution? Mid-30s?
It was on the retail sales basis about 30%, on the retail sales. On the reported revenue number could be, but we generally track this on secondary sales basis. Secondary sales basis, it was 30%, close to 30%. So that is where we want to go back to for sure. Market share, Nigel, it is best estimate which we do. There is no industry-wide data. We believe we are at 7% and we should go towards 7.5 to 8% at the end of FY24. When we talked about 10% by FY27, it was on the basis of that 2.5x target which we fixed on the base of FY22. And we are on track to deliver that. Considering the historical industry dynamics, if we deliver that, our expectation is that it should be 10%. It is an outcome number. If industry dynamics change, industry expands faster than that. But we are more focused on that 2.5x scale of jewelry business based FY22 level.
Okay, so 2.5 times scale up of the jewelry business. All right, I want to understand a little bit about what's happening in the watches business as well. Are you facing a lot of competitive intensity there? Your margins over there have come in at around 11.5%. You had a target of 12 to 13%. Do you think you could make that? And, if you could just give us a sense of which way things are headed.
So margin, there was one-off in watch division this time, which costed 1% to the division. Otherwise, it would have been 12.5%. So we are fairly confident that 12 to 13% on the full year basis they should do. And they have potential to do that, maybe more towards 13% gradually. But because quarter one is at 11.5, so I will restrict myself between 12 and 13%. Analog watches have grown 8%. Within analog watches, we are finding premium segments are doing well. So we are having very well-defined strategy and action plans and everything getting in place that how do we, from mid-premium segment, we start inching towards premium segment. And you will see in coming quarters from our side what steps we are taking.
Okay, just one final question.
Yeah.
Got it. Sorry, we're running out of time. So just wanted one final view on what's happening in the eyewear business, because over there, Lenskart has been picking up quite a bit. Are you facing a big threat there? And what kind of average growth can you eke out?
So I'm not saying that we are facing big threat, but growth, what we would like to have, we are falling short of that. We did 10-11%. We would have liked a high teen growth number coming from this segment also. We are taking our actions, but yes, you are right. Profitability is sorted in that business because we want a profitable growth, not growth at any cost. But yeah, we would love that business also start delivering high teen growth number. But till that happens, really can't comment or project or predict for that.
Okay, all right. Thanks a lot, Mr. Santalia, for stopping by and giving us all those details. Wishing you all the best for the remainder of this year. For the time being, though, the street a little bit disappointed on those set of numbers. Stock down close around 2%. But as the management said, they'll maintain double-digit revenue growth, margins of 12 to around 13%, market share increases to around 7.5 to around 8% by the end of this year. And also the studded share will move up to around 30% for quarter 2 as well as quarter 4. Well, in just a bit, we'll hear from Mr. Karan Adani. He'll be detailing that big acquisition that they announced earlier today. Just to revise it, Ambuja Cements have gone ahead and they've acquired Sanghi Industries for an enterprise value of around 5,000 crores odd. With this, the capacity goes up to around 74 million tons odd and puts them on track to double their capacity, which they're moving towards 140 million tons. And in the next few years, that's by 2025, they see that with the expansions that they've already announced, plus this Sanghi Industries acquisition, well, they'll move to around 100 million tons or thereabout. It's a win-win for both because Ambuja Cements, well, they are getting, a foothold into the Western market. That's a good short market with around 6 million tons capacity. And they're looking at upping it to around 15 million tons. For Sanghi Industries, since the open offer is at around 114 rupees, the stock is locked in upper circuit with a gain of close to around 5%.
Okay, and the big mover on the downside is UPL now. If you're just tracking that stock, it's down 3.5%. A lot of brokerages have cut their target prices and earnings estimates on UPL. Citi has cut the target price to 800. Jefferies has cut their target price to 800 as well. I mean, still above the current market price, but they talk about how there's a lot of pressure on both volumes as well as on prices. So that is really a big mover on the downside. Gujarat Gas is the other one that is taking big turn for the worse after a very weak set of numbers that Gujarat Gas has reported. So that stock too is down almost about 3.5% as we speak. And Metropolis. So, the market is kind of punishing a lot of weak numbers. And on the flip side, pharma continues to do well. Sun Pharma, ahead of its earnings, is your big mover right now. That stock is up and about. But of course, Ambuja Cements, let's go straight across to Karan Adani.
Have approved the acquisition of Sanghi Industry Limited at an enterprise value of rupees 5,000 crores. Ambuja Cement will acquire 56.74% shares of Sanghi Industries from its existing promoter group, Mr. Ravi Sanghi and family. Sanghi Industry runs an integrated unit at Sanghipuram in Kutch district of Gujarat. It has a clinker capacity of 6.6 million ton per annum, cement capacity of 6.1 million tons per annum, and limestone reserves of 1 billion ton. The cement capacity will be expanded further and will be taken to 15 million tons per annum in next 2 years. We will also invest in deepening and expanding the captive port capacity in order to accommodate larger vessel sizes of 8,000 DWT. Our vision is to produce lowest cost clinker in the country at Sanghipuram and then transport this clinker as well as bulk cement through coastal routes to the markets of Saurashtra, South Gujarat, Mumbai and Mumbai Metropolitan Region, Karnataka and Kerala. Synergies with the assets of Adani ports will help us in implementation of this strategy. With the right implementation, we are very confident that we would be the lowest cost supplier of cement in all of these markets. The acquisition of Sanghi Industries will help Ambuja to strengthen its market leadership and increase its cement capacity to 73.6 million ton per annum from the current capacity of 67.5 million tons per annum. With the ongoing capex of 14 million tons per annum and commissioning of 5.5 million tons per annum of cement capacity at Dahej and Ametha in Q2 of FY23, the Adani Group's capacity will be 101 million tons per annum by 2025. Ambuja's goal of 140 million ton per annum capacity by 2028 is well on track, and with this acquisition, we are very confident that we will achieve this ahead of time.
Okay, well, that's Mr. Adani talking about the acquisition announced earlier today. Sapphire Foods is the next company that we are focusing on. First quarter EBITDA came in lower due to higher other expenses. Profits were lower as well due to tax expenses versus credits and high depreciation. Sanjay Purohit is Old-Time Director and Group Chief Executive Officer at Sapphire Foods India. He's joining us right now to talk to us about those numbers and how things look ahead. Thanks very much, Sanjay. Good morning. Great to have you here. Prashant this side. Let's just start with margins, I think, which is the point of contention for many. Consolidated EBITDA margins have seen a contraction of almost 170 basis points. They've come in at about 18.6%. They were at about a little over 20% same time last year. Could you tell us what happened and how are things looking like in the second quarter and what will they be at for the full year?
So good morning, Prashant. Nice to come on to the show. Yes, margins, while margins have seen a contraction, I think we've got to look at the entire picture. So we've consistently said that post-Diwali of 2022, we've seen a softening of consumer demand, and that has translated into lower same-store sales growth across both the brands and then also in Sri Lanka. So having said that, the KFC business has delivered a really strong financial performance. So we've grown top line at 21%. Store growth has been at 30%, and therefore we've had flat same-store sales growth. Normally, when you have flat same-store sales growth, you would see operating deleveraged kicking in, but we've still delivered one of our highest restaurant EBITDAs. Pizza Hut is where the sales trajectory has continued the way that it has over the last 3 quarters. And we've had negative sales, same-store sales growth, and therefore operating deleverage of contributing to lower restaurant margins of 9%. Last year, same quarter, we delivered close to about 14.5%, 15%. Our Sri Lanka business also, while now stable, is starting to recover, but again, restaurant margins there have been hit a bit, and we've delivered 13% restaurant margins. So if you look at the combination of the three, KFC delivering higher restaurant margins, Pizza Hut much lower, and Sri Lanka a little lower, has contributed to our consolidated EBITDA coming in at 18.8%, a little lower than last quarter.
What is the outlook then, Sanjay, from here? Will it trend at similar kind of levels?
So we're not seeing any remarkable improvement in consumer sentiment at this moment, Prashant, and hence quarter 2, perhaps quarter 3, we will see a similar kind of trend, and then I expect that towards the end of the year and towards perhaps at the beginning of the year, we should see an improvement in sentiment. Quarter 2, in any case, is a bit of seasonality comes in, especially for KFC because of the festivals and the higher proportion of vegetarian sales. But I think in all of this, I think we've consistently said that what can we do with which is within our control? And what is within our control is product innovation, higher level of advertising and marketing spends, and then improving customer, the whole customer experience. So sure. I think on both product innovation, KFC has launched a 99 rupee range. Pizza Hut revamped its entire range. Value we are offering, which is on par with the rest of the industry, perhaps a little better. We've upped our marketing spends, especially on Pizza Hut. And in terms of customer experience, we've been rated the #1 franchisee globally by Yum.
Mr. Purohit?
Yes.
Got it. Thank you for joining us. But, just one follow-up before I move on. Has it come as a surprise to you why there's been such a steep fall in the same-store sales growth for Pizza Hut particularly? I mean, have you got to the bottom of it? Is it competitive intensity? Is it that the segment as a whole is seeing lower consumption, or is it something to do with the brand?
Yeah. So, overall consumption post-Diwali last year took a serious fall. And when you correlate it to GDP fall, or there's a lovely metric within GDP called private final consumption expenditure, which really tracks consumer expenditure, you'll see that fall happening. And much of our businesses are finally also dependent on discretionary spends, overall discretionary spends. So they've tracked that. Now, after December, there's not been any further reduction in, the kind of sales that Pizza Hut is delivering. Last year, the first half was outstanding for the brand. We delivered high ADS, 15%, EBITDA, restaurant EBITDA margin. So certainly we've taken a fall from there. That fall has impacted restaurant margins. Undoubtedly, competitive pressure on the pizza category is undoubtedly higher than perhaps,
So would you, sure. So would you at some point re-look at your full year guidance? I mean, you had earlier spoken about almost 23 to 25% revenue growth. Given that you're facing so much challenges, would you want to scale it down?
Yeah, Sonia, we don't give year-on-year guidances because this consumer category has ups and downs. I think we give a 3-year category, a 3-year guidance. And 3-year guidance, we've said we'll double store count, we'll increase revenue by 25%, restaurant EBITDA by 30%. I think we are more or less there from a 2-3 year perspective. We will always see these sinusoidal curves when you look at the consumer business. It's not anything new for us. When you look at all the FMCG majors and have been seeing their results, it's not a pretty picture at this moment.
Okay. Well,
right. Just one very briefly, Sanjay, and maybe this is with regards to all the blocks, etc., which have been happening. Could you tell us if we should expect anything in Sapphire in the near future?
No, nothing that I'm aware of. There was, I think, one of our first investors who had invested in 2015-16, Goldman Sachs. I think they exited in last quarter, but really, I think otherwise it's quite stable.
All right, fair enough. Sanjay, great to have you with us here. Thank you for providing that clarification. Appreciate your time here on CNBC-TV18. And good luck. And we'll speak with you soon again. We'll take a quick commercial break here. We come back with Quest Corp's management on the back of earnings. So stay tuned. Markets, by the way, are doing just fine. So they've been kind of taunting just under the green line. I mean, we're down 30 points, but we've spent majority of the trading session so far with cuts of less than 10 points or so. So it's a flat kind of day so far. Stay tuned. We're back.
Welcome back. It was a weak performance from Corp in Q1. The revenue growth has slowed down while the margin pressure continues. We have Guru Prasad Srinivasan, the Executive and Group CEO, and Kamal Pal Hoda, the Group CFO of Corp, who join us now on the show. Gentlemen, morning to both of you, and thanks for taking the time out. Mr. Srinivasan, I want to start with you. You know, in FY23, your revenue growth was quite strong. It was almost 25%. But in Q1, you barely managed to do about a 15% growth. What do you think you would end FY24 with? Will it be slower than the preceding year?
Sure. Thanks. Happy to join you on the show, Soma. First and foremost, in Q1 we have added about 14,000 plus headcount, and on quarter-on-quarter annualized year-on-year basis, we have grown about 14%, 16% year-on-year growth. Coming specific to workforce management, general staffing business, we have added about 13,000 by headcount, and followed by the second largest platform, which is Global Technology Solutions. We have crossed about 100 crore of our first-time EBITDA contribution from that business. And our workforce our operating asset maintenance has been steady and stable. So, there was slight weak demand in Q1, but we are seeing a better Q2 and Q3. The season demands are picking up from few sectors, specifically from BFSI, manufacturing, and some open up on retail happening. So with that, we are estimating, and we are confident that I think we'll be able to grow about 20% this year.
20% revenues in FY24. So things will have to pick up Q2 onwards. Got that. Gentlemen, good morning. Mr. Hoda, if I can come on the margins. In the fourth quarter, you cited a slowdown in specialized staffing and investments in the US staffing business as the reason for margin pressure. But we've seen further pressure in the current quarter. Could you tell us what is the goal? Is 4% the goal here?
Yes, definitely. That's the target that we aspire internally for. And you rightly pointed out, specialized staffing continues to not do well for us. In fact, it is down 73% year on year. And the turnaround that we were expecting in North America is also taking a bit of time, but we hope to break even in North America by Q3. And that's the target of EBITDA margin.
Can you tell us, on the debt situation, Mr. Hoda, what is the debt currently right now? I think you had said in Q4 that your debt has come down by about 57 crores or so, and it was somewhere to the tune of little over 500 crores. But at the end of Q1, where does it stand?
We further reduced our debt by 15 crores. Cross debt, we have further reduced by 15 crores during Q1. And we are pretty comfortable from where it was. So we, if you look back 2 years back, we were actually at a 1,300 crores debt level. We have come down to, sub 500 levels, and we'll continue to reduce debt levels from this point onwards.
So how much do you think your debt levels could get reduced to by the end of FY24?
We expect to at least cut our debt by minimum 100 crores this year.
Okay. Mr. Hoda, just to go back to that margin point, do you think you'll do 4% this year, or is there a chance that you perhaps fall short? Do you want to kind of guide the market a little lower, or you'd want to stick to 4%?
See, we aspire to exit this year, touching almost 4%. And this is also on the backdrop of all our 4 platforms, firing full throttle. The most important in this would be to also, get product-led business and found it to get into a break-even by exit of Q4. So definitely Q4 exit, we are targeting internally a 4% exit for all platforms put together.
Okay. Mr. Srinivasan, just very briefly, the global tech solution business, that is doing well. I think that's achieved the highest EBITDA of about 100 crores, margins of 18%. Could you talk to us a little bit about that? What's the potential here?
Sure. We have 3 set of businesses under Global Technology Operations. One is the customer lifecycle management and IT services, and we have the platform-based business. What is contributing to our margin expansion is from our international customer lifecycle management. So we have grown almost 21% in 1 quarter in our international BPM space, which is also a high margin business, which is taking up our margins. The domestic customer lifecycle management business, our contribution we have, we have started. If you look at our contribution in other space in this particular segment has gone up. So which is overall, pushing up our bottom line in terms of our EBITDA margin. So at fairly good growth rates on annual basis. So with that, we are quite bullish the way our order books are and the kind of market focus that we have through our sales. We are quite confident to grow this on an average at 15 to 17% on annualized basis.
Okay, all right, gentlemen, thanks for joining in and speaking to CNBC-TV18. That's Quest Corp. The stock is down about 3.5% on the back of a slowdown that they saw in their revenue growth compared to what they did last year. Let's slip into a quick break. On the other side, our special segment, It's the Economy. Lata will catch up with Hemant Mishra, the co-founder and CIO at Scoop Capital, and Steve Englander of Standard Chartered to discuss more on the economy.